So if you're planning on selling that house, or if your real estate agent is working with you to try to get things done, you may have heard you're probably going to be on the hook for paying something called capital gains tax. What exactly is it? See, when you sell real estate in the United States, the profit is referred to as capital gains. When I say profit, I mean the difference between what you originally bought it for minus what you sold it for in whatever that length of time is. To keep it simple, capital gains tax is essentially what is owed on the profit that we just discussed. So the profit made from the sale of the property. There's two types. First type of capital gains is short term. These are the profits that you get from selling an asset that you have had for at least 1 year. Capital gains tax are taxed at a rate of typical income tax. So anything between 10 and 37%, depending on where you are on the income spectrum. And then there's long term capital gains. Long term capital gains are also profits that are realized from selling an asset, but you've had it for much longer than 1 year. The tax rate is almost always lower for a long term capital gain, typically between zero, which we're going to talk about today, and upwards of 20%, depending on your tax bracket. Because of this, it's usually much better to hold onto your assets for a longer period of time. So let's talk about how I'm going to compile a lot of the classes that we have had over the last 12 months. So I'm going to start putting these pieces together for you so you can start taking advantage. Number one, go for the primary residence exclusion. If you're selling a home that's been your primary residence, you've lived in it for a minimum of two in the past 5 years. So you've lived in it for at least two of the consecutive 5 years before this. As much as $250,000 of capital gains can be excluded for a single tax filer, and as much as 500,000 of capital gains to be excluded for a married couple filing jointly. This is sometimes referred to as the 121 exclusion because it refers to a corresponding IRS regulation. Generally, you will not be eligible for this exclusion if you excluded the gain from the sale of another home during the 2 year period prior to selling this one that we're talking about. A quick reference, IRS publication 523 will answer all of this for you in a format that you can't possibly understand. For the complete eligibility requirements, you can get them from that publication. It'll also show you the limitations on the exclusion amounts and exceptions to the 2 year rule. But to give you an easy example, Mr. and Mrs. Smith sell their home. They have been in it for 5 years because they found their dream home and they decided they wanted to exclude the gain. But then Mr. Smith transferred his job to a different location and now they've got to sell their house. In this scenario, they cannot exclude the actual gain itself. So it's important for you to understand what the full eligibility requirements are. Second rule you need to understand, using the 1031 exchange. I have a whole course on the 1031. You absolutely want to know this one inside and out, especially if you are doing investment purchasing or if you are using multiple homes. So, if an investment property is being sold and you're planning to purchase another one, you can use the 1031 exchange, typically, also known as a like kind exchange, to defer paying the capital gains tax. I say defer because ultimately down the road, unless you're really super good at how you're going to be using these tax umbrellas, you'll pay it much later down the road. But the 1031 exchange rule says you need to follow a couple of things to qualify for it. First, both of the properties have to be in real estate rather than personal property. Both properties also have to be located in the United States, so none of the international stuff we've been talking about is going to qualify. If you have to identify your replacement property, then you have to do it in 45 days and then complete the exchange within 180 days. Sometimes there's a difference between the prices of the two properties. So this is called boot. If this occurs, you may need to pay taxes on the difference. For example, sell a property at 500,000, buy one that's only 350,000, you will be responsible for the gains against that differential if it doesn't follow all of the other likely rules. So when it comes to determining who and what type of transactions are going to be eligible for a like kind exchange, just take note that there are a couple of exclusions. Second homes are excluded, primary homes are excluded, partnership interests are excluded. You cannot do the 1031 exchange on those at all. Quick example, John's investment rental property value went up, so now he wants to invest in a different property. So now he wants to avoid paying capital gains taxes. So he'll conduct a 1031 exchange, putting the proceeds from the property he sold, his original property, into buying the new property. Essentially, just taking money that was already invested in the real estate market by John, moving it into a different property so he continues his investment in a like strategy purchase. Number three, utilizing installment sales, ultimately what we used to call seller financing. We even called it owner financing at a certain point. In this method, interestingly enough, in this method, when the seller provides money to a buyer because of the equity of the property, the seller will receive the money each month until the balance is due or the amount is completely paid off. This is beneficial to a property owner because it provides them with a steady stream of income. Plus, it has several tax benefits. Let me give you a little better example for this. If you sell that property for $500,000 and it's structured in an installment sale over a period of 10 years, the capital gains liability is also spread over that installment time period. Each of the payments consists of interest, gain, and principal. So when you report the income from the installment sale, you're going to use Form 6252. You're going to receive 10 installment payments in 2025. You would put only those on this form, not the full purchase price of the home. So you're only getting hit with capital gains for what was collected in this tax year period. I actually have a deal that's being strategically purchased that way now in Kissimmee. Very cool for the owner. He's in a situation where it makes the most financial sense because he was in the home for a very short amount of time, needs to still be able to use his benefits, by the way, and this allows him to do that and sell the home, and to the benefit of the buyer, take advantage of the longer time period, not having to go get other financing. So, two main benefits to this strategy. First off, the tax deferral. Rather than paying the full taxes on the sale, you're only going to pay the taxes as the payments are received. This is going to reduce the taxes that you pay immediately and the out of pocket expense for it. Huge differential, especially when you're talking about large gains on a property. Secondly, tax rates are potentially lower. So when the gain is spread out over many years, you're able to stay in a reduced tax bracket. So this is going to help reduce that tax liability overall, ultimately making sure you pay less. Number four, purchase in qualified opportunity zones, QOZs. Another option is going to be able to purchase a property in one of those opportunity zones. It's a good choice for an investor who has capital gains and is looking to defer and possibly reduce the tax liability almost to zero. This is particularly true with long-term horizons. This is going to allow them to minimize the benefit when they hold it for 10 years, long-term, long runway. It's also a great opportunity for real estate developers and investors who want to contribute to the development of an entire community. So there are deferral benefits based on the QOF length of time, and this is where you're going to make out. So when you hold an investment in a QOF for that qualified opportunity fund for a specific amount of time, you're going to enjoy those significant benefits in correlation with the gains themselves. So if you hold right now, the way the laws are structured, if you hold a QOF investment for 5 years, then 10% of deferred gains. 7 years, 15% of deferred gains. 10 years, you've got the possibility to exclude the appreciation from exchanging or selling the investment of your taxable income almost entirely. It allows the government to strategically utilize investors in areas that wouldn't normally be invested in. They gain because you're moving a population into a less populated area. It helps the investment area. It helps people develop larger communities, and the government sees that as beneficial in their long term, so they pass that benefit back down to the investor. Number 5, converting a rental property back into a primary residence. If you want to avoid or minimize tax obligations entirely, you can convert a rental property into a primary residence. Keep in mind, you've got to live in the home 2 out of the 5-year period before selling it in order for you to qualify for this at all. So this is called the home exclusion. And again, you get the $250,000 exclusion for single filers, $500,000 exclusion for married couple filing jointly. Depending on your specific tax circumstances, you might even be able to deduct expenses for a time in which the property was either rented or used as the primary residence. Here's how you might be able to calculate some of those amounts. I'll try to keep it simple. So when you're converting a rental property into a residence, the first thing you're going to do is calculate the adjusted basis. Begin with the original purchase price, subtract any claimed depreciation while the property was being used as a rental. Add the cost of any capital improvements. These aren't maintenance or repairs made on the property. This is a capital improvement to the property. Big difference. These are typically renovations or things that needed to be improved or updating to a residency. Again, not maintenance. And then you add on the selling cost, the legal fees, the repairs done prior to the selling to make sure that it was market ready. Realtor fees are included in that, etc. Secondly, that's going to help you figure out the total gain. This figures out by subtracting the adjusted basis from the selling price that you're looking to capture. Then you're going to readdress the depreciation. If there's been a depreciation claimed on the property while it was used as a rental, it has to be recaptured. So you must report it as regular income now, as it was taxed at the regular income rate up to about 25%. Then you're going to allocate the gain between the two, qualified and non-qualified usage. So for properties purchased after 2008, a special rule required the proration of gains when the property was used for non-qualifying purposes, like rentals, before being used as your primary residence. Again, we are still talking about the same situation where we took a rental property and we've now moved back into it. The gain's going to exclude the amount that is reduced, the pro rata base for the ratio of years of the non-qualifying purposes versus the total years of ownership. For example, if you own the property for 7 years, rented it for 2 years, then only 5/7 of the gain qualifies for that Section 121 exclusion. And then you want to apply the Section 121 exclusion. You meet the ownership, you use and those use tests, owned it, lived in the property as your primary residence for at least 2 of the 5 years before you then sell it, you'll be able to exclude the portion of the remaining gain for taxation. So exclusion again, $250,000 for a single filer, $500,000 for married couples filing jointly. And then you calculate that final taxable gain. The remaining gain after the accounting for the depreciation recapture in section 121 is going to allow you for the exclusion, which is going to be taxed at your applicable gains tax rate. That should be clear as mud. If you want to hit me up in the section below, I'll get you the formula. It's easy to understand when you see it on paper, a lot simpler than me just kind of reading it out to you. So let me know. Happy to show you how it works. Number 6, harvesting tax losses in the same year. So if you have other investments that have lost value and you do not intend to keep them, you can time the sale of these investments to be in the same year as the sale of a home. So sell your investments at a loss can allow you to use the losses to offset capital gains you have from the sale of a property. Example, you're sitting on stock that you initially purchased at a net cost of $100,000. The stock's now worth $20,000. Here's where the real estate investment can help in the capitalization of market investment and how they can balance when you're diversifying a full portfolio. That's the words that I was looking for. So you're holding stock in a company that you initially purchased for $100,000. The stock's now worth $20,000. You can sell the stock in order to claim the losses, which is sell it, take the $80,000 loss. Now, take that $80,000, let's put it on this side. Now let's say you sell a property which incurred capital gains of about $200,000 in profit. While you would ordinarily be required to pay the taxes on that $200,000, selling that stock holding reduced that tax bill by 80 grand. So you'll only be taxed on the $120,000 differential of that capital gains. So again, if you're going to decide to go that route, I absolutely always recommend talking to a consultant or a tax expert to make sure that the sale of the investments can allow you to do that offset and make sure you're selling it in the right amount of time. But it'll certainly help you almost zero out any type of capital gains that you were utilizing above. And that way, one of your investments is kind of protecting your other. As a tax rule and regulation can be complex enough, highly dependent on your specific set of circumstances, that tax consultant's going to be able to really help you out and make sure that you're taking care of things in the same tax year when you need them most. Selling the property in a different year. Your capital gains rate is based on how long you've held it and what your taxable income bracket is. So, since your taxable income bracket can range from 0 all the way to 37% for short and long-term taxable gains, choosing to sell the property in a lower income year can also help you pay taxes based on a smaller tax bracket, even if the home value remains the same. You've had a huge job change. You've had to liquidate several investments, but ultimately you made less money that year. You also decided to sell the house, taking that taxable differential in that same time year is very beneficial to you as an investor. Let's talk about write-offs for just a minute, because this one comes up a lot and people have a tendency to expect dollar for dollar value in any investment that they sink into a home. We as real estate agents understand that, sorry, your gold-plated bathroom faculties that you installed do not increase the time, attention, and value to the property. It certainly will help shore up and make the house more attractive for those that are looking to buy it. But you're not putting yourself in a position to where I spent $50,000 on very expensive fixtures in my house, and now I'm going to add that $50,000 of value onto the top of the selling price of the home. Absolutely not the way it works. So, improvements. If you made improvements to the home prior to selling it, needed to get it market ready, it is possible that you can adjust your initial cost basis. So this is something that can reduce the capital gains liability upon the sale of the property. Example, buy the home for $500,000. Subsequently, you had to install a new roof, a new HVAC system for the total added cost of $100,000 of maintenance. Your adjusted basis could become $600,000 because of that. If you later sell the property for $800,000, you'd only be responsible for the capital gains on $200,000 of profit rather than 300 because of those 4-point requirements of keeping the home maintained that you had to invest in even to get it sold. And in the Florida market especially, if you've got a home that's got a roof or an AC system that's approaching 20 years and has not been well maintained, you are absolutely going to be forced to replace this or give a sizable concession to the buyer party so that they can make sure that they can have an insurable property on their hands. Not all improvements, by the way, made to your home can be added to the initial cost basis. Generally, it has to be something that materially adds value or significantly improves the lifespan of the property. Home improvements that are likely to qualify are things like new roofs, for sure, insulation and plumbing replacements, installation of a new roof or windows, replacement or improvements to walkways and driveways are included in this. Installation of fences or retaining walls. And this is not fence maintenance. This is installation of new fencing. And then installation of new appliances and or flooring can also qualify. Of course, with all of those ways of keeping as much of your taxable income to yourself as possible, right? And as long as you're working with an accountant, you're not going to have any problems doing this legitimate and keep everything above bar, inclusive of all your receipts, etc. There's some common mistakes, some easy things that I can help you avoid so that you can minimize some cost. When it comes to capital gains taxes, there are several things that you really need to consider and things you should avoid entirely because they will absolutely cost you money. The big one that I see that damages my clients is selling the house too fast, regardless of their situation, regardless of a new need. Common mistake that they make is selling the house simply too quickly. When you sell a home within 1 year of purchasing it, any profits you earn are considered short-term capital gains. You will pay the highest amount of income tax possible based on your tax bracket. It is absolutely best to own a home for at least 2 out of the 5 years that you have put into it to make sure that you can manage the long-term capital gains rate. Second thing that I see my clients make the mistake on is forgetting about state taxes. Even though long-term capital gains get taxed at a federal level, a lot of states impose them at a state level as well. So there are states that have minimum rates similar to regular income tax rates. This will negatively impact that tax amount monumentally. When you don't consider those taxes too, you're going to find yourself in a very poor financial position when it is time to capitalize on the monies from selling the property. And then, of course, the third biggest mistake that I see is simply not considering the best sources of action, not talking to your real estate agent, not talking to your tax advisor or your financial advisor, and making just strategic pitfalls. Some of those strategies of deferral won't work for everyone that I talked about earlier. So you've got to figure out what's going to work best for your situation. Only you're going to know your whole story. You're going to be honest and open with your tax advisor and with your financial consultant. And certainly tell your real estate agent as much as you can and tell them it's under a single agent privilege so they can't share or utilize that information towards anything that they are doing with you. And that will put you in a position that they can give you the maximum amount of advice without leaning into transactional agency. Got some good questions today. Some of these I can pine through pretty quick. Can I deduct a loss when selling my house? Okay, great question. This one depends. There are some losses you can absolutely deduct. These include losses on the property that were used for business or trade, losses on transactions that were entered strictly to make profit, and certain qualifying casualty losses. We live in a big hurricane state here, so we deal with that quite a bit. So you just have to be careful if your home was completely devastated by a storm, or we're seeing a lot of rising rainwaters and a lot of floods and mudslides and those kinds of things across the country this year. Certain qualifying casualty losses will allow you to be deducted as well. How are sales from second homes reported? Okay. Second residents act like a vacation home. So these will be called a capital asset. Form 1040, Form 8949, these are both used in reporting exchanges and sales, and that's where you want to concentrate those in your reporting structure. Why do I have to pay taxes if I lost money on the sale of a home? Well, let's be clear. Yes, you have to pay taxes even if you lost money on the sale of a home. And generally, you can only do so if the home was an investment property. Primary residence, very different set of rules. So make absolutely sure you're paying attention to that. If the loss incurred on a primary residence, you will be unable to treat it as a capital loss when you file your tax returns because it was not an investment property, even though, be careful with that word, it was an investment in your portfolio, simply not the same. Um, Lots of things you need to consider when you're talking about capital gains, and please make sure you're familiar with the specific tax codes for your state. Florida are pretty straightforward, and certainly some of the things that are happening at the upper legislative and the executive arms of our country may see capital gains make dramatic changes, potentially even go away. At this point, these are just rumor, but anything that the state, local, and the federal governments can do to help you keep more of your profits, your investments from you taking your risks with your money in your pocket, the better. Have a great weekend, everybody. Looks like it's going to be amazing weather in the state of Florida this weekend. So get out there and enjoy the beaches, enjoy the sunny attitude, and have a great weekend. My agent friends, do good business, continue to do good things, and continue to be the beacon of truth out there for your clients. They need your help. They need your advisory services. Please don't be afraid to reach out. If we can help you in any way, we're happy to partner in on any deal to make sure the deal closes well and effectively for you and your client. Have a great day, everybody. Take care now.